Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to show you the continuation of part 1, where we discussed capital allocation with a focus on dividend and share repurchases. If you haven't checked part 1, go and check it. I'm going to leave a link in the description because we are going to build up on what we saw in that video on this second video. So to summarize, what happened is we analyzed the capital allocation decision making of management when they have to use the sources of funds in an intelligent way so that they can maximize value creation for the long run for the business. And we were discussing about payment of a dividend based on an example that Mr. Buffett gave us in a shareholder letter of 2012. In that example, he used a hypothetical case where the return on equity of the company was 12% and the price to book was 1.25% or 1.25 times. And what we saw there is that it didn't make sense for management to pay a dividend in that case. So this is what I am doing. I'm replicating Mr. Buffett's example in these spreadsheets. And the comparison here was that if you see the net worth of the shareholders is going to be higher in this case, in the sell-off alternative. So this is summarizing the example that Mr. Buffett published in that shareholder letter. So I said, okay, what happens if instead of having these assumptions, we have different assumptions? Will this conclusion still hold, or will it change? So I did a table in which I changed the price to book and also the return on equity. And what I'm showing here is the difference between the sell-off and the dividend approach in percentage. So you can see, for example, that when price to book is 110 and return on equity is 10, there's a case where the situation is the same. It's indifferent whether it's the sell-off or the dividend approach. And also in 1.11 and return on equity 11. So you see the pattern here, 112, return on equity 12. So the pattern seems to be that when the price to book is equal to 1 plus the return on equity, the two options are indifferent. And also we see here that when, in this case, the sell-off is better, when the price to book is higher than 1 plus the return on equity. So when this equation is higher. And in this other portion, the dividend is better when the situation is like this. It seems to me that because in the sell-off scenario, the shareholder has to manufacture the dividend and has to sell stock. If it can sell stock at an overpriced value, let's say, it of course would be better off. While if it has to sell the stock at an under price or below the fair price, then of course it wouldn't be that efficient to manufacture your own dividend. So I thought that probably this indifference comes when the price of the stock is exactly fair, or the stock is trading at fair value. If we can calculate the fair value of this company and see whether the fair value is exactly this formula, fair price to book is equal to 1 plus return on equity, then that would be the case. If we go to our spreadsheet, that would mean the fair value for the sell-off alternative, because there is no cash stream during the 10 years, the fair value would be the value at year 10 of the company, the net worth that we have at the beginning, plus what we earn during that year, is going to be the value at the end of year 10. If we discount that to the present at a certain discount rate, that would give us the fair value of that company. So I did that in a formula that I'm going to show you now. So this is what I did. In this formula, what I'm doing is I'm taking the equity plus net earnings at year 10 and dividing that by 1 plus return on equity to the power of 10 to bring it to the present value, and I'm using return on equity as the discount rate. So our fair market capitalization is going to be, if we replace here net earnings by return on equity times the equity at the start of year 10, we have this formula. And then if we divide the fair market capitalization by equity, it's the same as saying fair price to book. And if we do that in this formula, the fair price to book, that formula will have to be divided by equity, which is what we did here. And we see here equity times 1 plus return on equity to the power of 10. This is nothing more than the equity in year 10. So we end up with this formula. If we remove this equity in year 10 out of the brackets, we will have this. And then what we can do here is just cancel these two equities. And we end up with the fair price value being 1 plus return on equity. Remember that what we are doing here is we are assuming that the discount rate we are using here is the return on equity. So if we go back to our table and remember that when price to book was equal to 1 plus return on equity, the two alternatives were indifferent, and that we just saw means that the stock is trading at a fair price. But then let's go back to the formula and do something else. We are saying that the return on equity that is being used as the discount rate. But what happens if we use the weighted average cost of capital as the discount rate? Let's replace that and let's focus on this formula here. So let's move this to make it a bit neater. And so if we now replace this return on equity here by the weighted average cost of capital, this is what we have. And remember that this whole portion of the equation is equal to 1 plus return on equity. So these are the things that can happen. If the return on equity is larger than the weighted average cost of capital, then this denominator is going to be smaller than before, than what it was here. So that means that the whole thing here is going to be larger. So that means that the fair price to book is going to be larger than what it was before, which was 1 plus return on equity. And the same thing we can say for the opposite. And we know that in this case, when company invests at a higher return than cost of capital, the company is creating value. And also the opposite can be said when the company invests as a smaller return than the weighted average cost of capital. So we can see here that when fair price to book is larger than 1 plus return on equity, it's creating value, and vice versa. And if we go back to our table, we see that this is what's happening in this case. For example, in the sale of better alternative, all this was when the price to book was larger than 1 plus return on equity. And we saw that the sell-off is a better alternative, and also is when the company is creating value. And the opposite happens here. When the company is destroying value, which is when the price to book is smaller than 1 plus return on equity, it was when the dividend was better. So what I think we have learned from this exercise is that the payment of a dividend should be seen in the same light as making acquisitions or investing in the business, meaning that the decision whether to pay or not a dividend must be taken in light of whether the company is creating value or not creating value. This is if you believe that management has to make the capital allocation decision based on creating value in the long term or maximizing value in the long term. So if that's the case, then this is what happens. If the company creates value, it should not pay a dividend and allow shareholders to just manufacture their own dividends. And if the company will destroy value by reinvesting in the business, of course, it's better for them to pay a dividend to the shareholders. So I think that this mathematical exercise allows us to understand better this decision-making process for capital allocation. Dividend payment should be seen in the same light as any other investment in the company. And it should be revisited frequently, I think, because not always the company can create value in the same way. The opportunities can change. So those companies that pay dividend for forever may not be doing the right job, let's say, in terms of creating or maximizing value for shareholders. So in the next portion, the part 3, we're going to keep analyzing the same letter of 2012 of Mr. Buffett. He gives us a couple of more reasons, not necessarily in the mathematical view of it or the financial view of it, but other implications of paying a dividend. So, okay, thanks very much for watching this part 2. I'll see you soon for the part 3. Remember, if you like the video, please give it a like. And until next video, thanks very much. Bye bye.